For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
Oh, thank you, me. That was me doing that intro right there, which Professor Plum never gets to hear. Let me just start off the show by saying I'm your podcast host. I'm Johnny Dean, your podcast host, right? I'm the owner of this podcast. I'm kidding. Hello, Professor Plum.
Hello. Yeah, last week you didn't announce who you were until about 3 minutes left in the show.
Was that
podcast,
what it was?
Whatever this is.
Yeah.
Yeah, you didn't announce yourself until at the end.
Well, I feel like I'm so well known, you know? I feel like everybody knows me.
Well, your posters in every post office.
Well, that's true. It's not my best. Actually, when they have you turn to the right or the left, I tried to turn to my left because I said this is my better side. They said, shut up. I kid because I love. No, I'm here as host of the podcast, Managing Your Financial Future, and my guest here, once again, Professor Plum. You've done almost every episode with me. Maybe I should stop calling you my guests because you've done virtually. Co-host, we really are. After having done this for so many times, I think you've only not been on.
We're closing in on 200. We're closing in on 200, though.
Yeah, as we said last week, and I did the count. I believe this is 196. I mean, it's like.
Man, I thought we were closer.
I know we got another month or so to go, which will take us darn close to the end of the year. So it may not.
So maybe the Christmas one will be our 200th.
Perhaps, although we're going to take a couple weeks off for Christmas. So, I can't believe we're this close. Anyway, let's get to it today. We've got so much to talk about. The topic came up 2 or 3 weeks ago, and just briefly as we were discussing something else. And I said, I think I'm going to make a note of that. As a topic to bring up here on a future podcast. So that happens to be today. And this has to do with how much can you take from your portfolio. Now, I know, Professor Plum, you can take the whole thing if you want, right?
I can take it all. It's my portfolio. I can do whatever I want with it. I can take it all right now. But the question wasn't how much can you take from your portfolio. How much can you take on an annual withdrawal and expect the portfolio to have something left in it for at least as long as I am still on this earth. And me being the person that owns the portfolio. So it's How much can you withdraw on an annual basis and expect it to last at least as long as you do?
Yeah, and a question did come up at one point, which was, is there a quote-unquote safe amount, if I can use that word, to withdraw from your portfolio? Now, this goes back to that adage, which was this in the 90s with the...
Bill Benjamin?
Yeah, the 4%.
Yeah, it was a little over 4% when he did it, but he did the studies in the 90s.
Yeah. Now
96, 97, somewhere there.
Yeah, and so it was. I was thinking it was like 93, 94. Doesn't matter. It's been about 30 years or a little more, and that was what they came up with. Now this had been revised downward back 4 or 5 years ago, something like that, when interest rates were at zero for so long. And they said, well, we can't earn much on our bond portfolio. We can't earn much on our safe money, our non-volatile assets, CDs.
Well, the idea of the
that.
4% rule in the begin with was if you had a balanced portfolio, 60-40, 50-50 stock bond mix, and you took a withdrawal from it, and what they did was they did thousands of what they call Monte Carlo simulations. They took random returns from the different markets, bond market, stock market, and just did testing where it just put random returns back to back over 30 years. And they didn't do rolling 30-year periods of time. They did the Monte Carlo testing where it took random 30-year periods of time. And so you could get, 1929, 1930, 2000, 2001, 2002, 2008, 2007, all strung together in one long line. And that would be probably one of the worst ones they would test against. And then each year they rebalanced the portfolio, or as they went along, they rebalanced the portfolio back to the original balanced mix, whatever they were using, 60-40, 50-50. And then each year they also increased the distribution by an amount equal to CPI. The CPI at that time, again, they were using Monte Carlos. So it was a matter of kind of trying to do not just it wasn't historical testing. It was worse than historical testing. It was the worst periods of time. And how long would it last? How long could that portfolio last? And they said they tried all kinds of different distribution amounts, starting from the original value. So they, 2%, 3%, 4%, 5%. They did it in more than just whole percentage increments. And the higher you got, 7, 8, 9, 10%, the less the probability of success became, which makes sense, of lasting for a potential 30-year period of time. And they picked 30 years because from 65 to 95, that's a pretty good life expectancy for most people. I mean, most people, not everybody makes it to 95. Not even yet with extended longevities. So the idea is, what is the way we can set up a portfolio and reasonably expect it to last, taking a retirement income distribution, cash flow distribution, and not have to potentially worry about running out of money? And so they came up with, I think it was 4.5% back in the 90s, and it would last 92 or 93% of the time. It would last 30 years. That's pretty good odds, But a problem with that is, first off, there's lots of problems with it.
We'll get to those. Yeah.
But it has to do with, are we even setting up our strategy the right way? I don't think so, but that's the way they did it. That's where the 4% rule came from. Then back when interest rates went into the tank, some other really smart analysts started doing more testing using similar variables, similar situations, and said with interest rates where they are now, this was back when interest rates were like maybe a quarter of a point for a good, good rate. We can't expect much from the bond side, and if interest rates do go up, we might lose some value in that bond side, and so we have to revise our potential 4% rule. And these very, very smart people I listen to quite a bit, these smart people would say, well, you really should cut it down to like 2.8%.
Right.
To give yourself a really high confidence level that you're going to last for quite a while. So if I had $1 million, I have to limit myself to a little over $2,000 a month to be able to say that for sure. Well, 90% of the times that meant that I made my heirs very wealthy, and I struggled during my retirement years. And so is it a valid rule? It's not a rule, but is it a valid way to look at a portfolio?
Well,
that's where we come from.
It is. And there are good things and bad things about this whole idea of, and we'll stick with the 4% because that 2% thing just really didn't fly. And there's a reason for it. But when we think about 4%, the bad thing is that people tend to think that they're limited to that in all cases, and we'll get into
never. I can never spend more than 4. It's a rule. Never, ever, ever, ever spend more than 4% of your overall portfolio.
Correct, and of course there are problems with that 4% that we've talked about, and we'll get to those here in just a little bit. But I think on the good side, it gives you a kind of jumping off point in many ways.
Oh, I think it's very useful from a very high level, looking into the future or looking just from a very high level. Am I in a reasonable position, or can I reasonably expect this to last? Now, I'm not going to just use their method all the way down the line, but I'm going to say, if I'm going to be 65, 66, and I potentially want to retire, my Social Security at this age would be X amount, $2,500 a month. My spouse's Social Security is similar, same, or whatever the number is. So between the two of us, we've got $4,000 or $5,000 a month. We might have a little bit of pension money, so that's $6,000 a month. I'm just making these numbers up, obviously. And we need $10,000 a month gross because taxes have a play in this overall thing. I need $10,000 a month. I'm, again, just making numbers up. And I'm getting 6 from other sources that aren't going to change. Then I'm short by $4,000
a month.
$4,000 a month, and so I'm short $4,000 a month, $48,000 a year. So from a 4% rule, it says I need about $1.2 million in my overall investment portfolio. Now, if I'm at $1.1 million or $1.3 million, or if I'm in the ballpark, I'm pretty close. I'm feeling pretty good. If I'm at 500,000 and I'm already 65, 66, I have to do some revision somewhere. It's not going to work. It's not going to last unless I just have a horrible life expectancy, or I have a great inheritance expectancy.
So there are circumstances, of course, where the you can take more than 4%. You mentioned, maybe I've got Social Security starting. Maybe I've got pensions or something like that start here in just a few years or a couple of months or at some point down the line. So this is why I wanted to get into this topic, Professor Plum, about how much can I take from my portfolio? Is there a safe amount? There really is no pat answer to that, and everybody wanted to know a pat answer to that. But
right, and they came up with as close as they could to a pat answer, and it actually works from a very high level, like I mentioned earlier. But it doesn't mean that you can't adjust things, because there's two things that can adjust. Like you said, maybe I'm going to get more income in the not too distant future. I'm not starting my Social Security yet, but I'm going to start it at age 70. The other side of it is maybe an expense goes away. Maybe my mortgage gets paid off in 5 years, and that's $2,000, $3,000 a month. So my need goes down. And so I might need a little bit more now, but I'll need a whole lot less later on. And so one of the things you should look at doing, and this is where the 4% rule can come in, is try to project out between now and when all the incomes are there and all the expenses are pretty much stabilized, whatever those might be. And then try to project, okay, I'm drawing down my portfolio faster than 4% right now. And then what will it be 5 years, 6 years, 7 years from now when all these other things happen and I'm fully into the stabilized values? What kind of a distribution rate do I have then? And that's one way to look at it and say, okay, well, I might be taking 8% now, but in 6 years from now, I'm 64, and in 6 years, I'll be 70. I'll start my Social Security, and my house will be paid off. So my income's going to go up by X, $2,000, $3,000, $4,000 a month, and my expenses are going to go down by Y. So while I'm spending 10 grand a month now, 6 years from now, I won't need anything near that, and I'll have more income to do it.
Right. Okay. So when you're putting a plan together for somebody, and you're just starting out, and you might go over with them what you just went over with us in the example that you gave, in that made-up example. And you might say, okay, well, let's talk about what guaranteed type money you have coming in. What's the foundation? So you would start with Social Security, and they might again say, just to bring up your numbers, well, between my spouse and me, we've got $5,000 a month, so that's $60,000 a year. Pensions, we have let's say $20,000 a year, whatever. Just making that up. And so that's 80. What did I say? That's 80 grand.
80,000 a year.
80,000 a year. We really need $100,000 a year. Those are the only guaranteed sources. My pension and my our pensions and Social Security. So we really need $100,000 a year, certainly at least to start off with. So Professor Plum, you're saying, well, okay, then that means you folks are $20,000 a year short. Actually, let's make it they need 120. So you say, well, you're about 40.
You want that 40, don't you?
I want that 40, yeah. So we need 120,000. We like to travel, and we kind of need this. And so, okay, well, so you're $40,000 a year short. Now, what you might do, and correct me if I'm wrong, Professor Plum, before you even know how much they have socked away, you might do that and say, well, let's see, they need an extra $40,000 a year. So just right off the top of my head, I'm figuring ballpark. I'm hoping that they've got saved up right around $1 million, because there is 4% right there, $40,000 a year, 4% out of $1 million. But now, would that be where you would start off, Professor Plum?
Well, it's a starting point, but then it comes back. Well, guess what? I don't have $1 million, and I'm not going to have. We're assuming the person is retiring right now.
Yeah,
I've only got $750,000. Is it still a reasonable, viable goal? It's like, okay, well, what else might be happening in the future?
There it is.
You've got a mortgage that's going to be paid off in a couple of years, and that's $2,000 a month. So your $40,000 a year just dropped from $40,000 down to $24,000 a year. And so we need to spend a little bit more than 4% for the first 5 or 6 years, but then after that, we've got a much lower much lower spend rate. So that might work. Or you say, I really don't necessarily want to count on it, but I've got parents that are still alive, and they're in their early 90s, and they've got, okay, there's 2, 3, 10 kids, however many, and they've got $10 million, and they're probably not going to spend it all before they die. So I'm going to get something out of that. And I've seen, but on the other side, I've seen people say, yeah, I'm going to get an inheritance. The parents have got about $500,000, including their house, and there's 10 of us. It's like, well, unless you're the favorite one, and that may be spread a little thin, maybe you only get 1/10, you get 50,000. How much are we really counting on? Plus, if they have a long illness or something that happens at the end, they could wipe out a big chunk of that nest egg that you think you might be inheriting. So inheritances are hard to count on unless we're getting closer to the unfortunate issue that this becomes more real.
Sure, unless you know that. Well, look, let's say it's only me and a sibling. There's two of us, and Dad's the only one left. He's 93. He's okay, not he's slowing down. He's got a couple of years left, but he's got $4 million in the bank, and quite frankly, he's not going to be spending that. You can
so we could count on some of that money probably coming your way.
Yeah. But so to get back to how much you should take out, there's a reason that if somebody really wanted to retire right now, they could theoretically be taking maybe 8%, 9% out of their portfolio.
We see that quite a bit for somebody retiring at age 65, where they think they have longevity on their side. They think they're going to live a long time. So they want to wait until age 70 to take their Social Security, which would be somewhere between 24 and 28% higher than it is now. Mm-hmm. And you got to live long enough to make that worthwhile. But they're planning on living a long time, and so they wait till 70 to take their Social Security, so they're not getting that extra income now. So they have to take more out of the portfolio in the early years, and then they'll be able to take a lot less out of the portfolio in the not too distant future, later years. And so, we see 7, 8, 9%. And like I said, we see 10% at times because things are happening. Social Security kicks in later. A pension kicks in later. Biggest one that I've seen, the biggest expense that goes away is the mortgage. But other things that could go away are maybe they had kids later in life, and we see people retiring with bills for college.
Wheezy, this is the big one. This is it. I'm coming. Yeah. Oh, that would be wow.
It happens,
sure. Of course.
So it's all a matter of your specific situation. So while the 4% rule is a great high level, am I headed in the right direction type of planning aid, it is not something to live by forcibly. And the other thing is with the 4% rule, okay, so I start with $1 million, I take my 40,000 out. What if this next year is not the best of years? Maybe it's a bad year, and the overall portfolio goes down by 15, 20%. And you say, well, balanced portfolios don't go down by that much. Yeah, in 2008, the average balanced portfolio went down by 25%. The market went down by 40 something, but so maybe my $1 million, which is now 960 because I took 40% or $40,000 out of it, went down by 20 some percent. So I'm down to $750,000. Do I then say, well, then the next year I can only take $30,000 out because that's 4% of the 750? Or do I just let it ride? How do we want to apply the 4% rule each and every year going forward if we have a negative year? On a positive year, maybe we have a year where the market goes up 15, 20%, my balanced portfolio goes up 15, 20%, and then do I adjust and say, well, now I can spend more money for the rest of my life? That's one of the drawbacks of that overall rule as a specific withdrawal strategy.
Yeah.
It's a great way to do from high end, but it's not the strategy to be following.
Getting back to what you were saying a bit ago, which is, sometimes depending on what's coming up and what you can expect over the next few years, you may be able to take as much as 8, 9, 10%. At what point, just as a sidelight, at what point do you think that maybe, even if you got something coming down the road, would you say, that's honestly too rich? I mean, I got to think that if somebody says, well, I'm going to take 20% out of my portfolio for the next 3 years, I've got to think that, is there a point where you say even that is a bit too much?
It's all circumstantial, and it depends on what's happening after that, in your case, 3 years. So we're taking 20% out for the first 3 years. So we've taken 60% of the portfolio for those 3 years. I have seen it where people take a higher percentage than that for the first 2 or 3 years, and they have very little left. But once they get past that turning point, whatever it is, that's when the Social Security kicks in. That's when the pensions, and maybe they retired at 60, and they just need to make it to 65, 66, 67. And by the time they get there, then their big old pension kicks in, and they're going to have more money than they could ever spend in their lifetime. It's not often. It doesn't happen this way very much. But I've seen it happen where people are deferring their pension, they're deferring their Social Security. And once that starts, they have more income from just those sources. They need absolutely nothing from the portfolio going forward. And so, but that's a rare instance. So you said, does it ever work? Yeah, it works. It's all specific, situational. What is happening in your life that that allows this? Now, if somebody said, I need to take 20% out a year for the next 10 years, well,
that's
math doesn't work that way. It doesn't happen. Even 10%, and I need it to last forever. Well, unless your forever is only 12 years or so, it's not going to make it, because it just doesn't happen. And you either have to take so much risk that you could run the risk of running out of money even sooner than expected to be able to try to make it last, that hopefully you get a great sequence of returns. Boy, that phrase just keeps coming up every week because it's an issue. What is going to happen? How do we manage that risk? I mean, somebody needs this. So two things happen when you do it correctly. You can you start with your 4%, however you look at it, but you manage your risks. There's times where somebody has a very low distribution rate, but they still don't want to take the risk. So even though they can afford to take more risk because they have a very low distribution rate, let's say they needed, $1,000 a month from that portfolio out of that $1 million. And so what's 30 years, 360 months, I could take 360,000 of the money and put it in the bank and draw 1,000 out of it, and that'll last me for 30 years without any risk. And that means I have 640,000 that I could do anything I want with. They can afford to take risk with that because they're never going to need it in their lifetime. But in their emotional psyche just won't let them do it. So that's just because you can doesn't mean you should take the risk. And there's other people that have to take the risk because they can't afford to do it any other way.
Again, that's true, and you've seen circumstances. You've seen both of these circumstances. Now, here's something that somebody might be asking, and they might say, "Okay, well, let's say I have this $1 million portfolio, and I'm 62, and my pensions and everything are going to kick in when I'm 65." And my Social Security will kick in. I've got $1 million, and I need $120,000 a year. So I'm going to take 12% per year out of this. Or I'm going to take $120,000 per year out of this $1 million portfolio, with the proviso that all my guaranteed stuff is going to start kicking in. And at that point, at age 65, I'll only need to take $40,000 a year out of that. But somebody might say
that's not going to work.
Well,
that's a little rich.
Well, an astute person, or even if you don't, okay, let's say after that you only need.
Well, look at it just basic math. If I need $120,000 a year for 4 years, that's $480,000 out of that $1 million. That means you only have $520,000. What does that $520,000 have to grow to be able to take $40,000 out of it from 65 on for the rest of my life? High level planning says I need that to get back to $1 million. I need it to almost double in 4 years. All right, that's not going to happen.
All right, but I'm going to lower it because here's where I'm going with this. Let's say after that I only need $10,000 a year, okay, or something like that.
Okay, now we're cooking with gas, although that's going to be illegal sometime. Sorry.
All right, but let's say all right. So, but my point is on this, that somebody would say, okay, well, what happens in those 3 years, Professor Plum? And you mentioned sequence of returns. What happens? My $1 million, I take $120,000 a year. And then the next year, the markets just tank. We have a 30% drop. We have a 40% drop. I don't know. Something happens where my $1 million has shrunk. Minus, the 120,000 takes me down below, to 880. But my 880 is now down to 650. I'm just throwing numbers out there off the top of my head.
Well, if you are in that position and you've taken that much risk, you are doing it wrong.
That's where the strategy. Yeah, this is
flat out
strategy.
Wrong.
Okay, so
this is where strategy comes in. You should not have anything in the market that you need to spend in the next 10 years. I mean, that's too risky because we don't know what the sequence, here it is again, sequence of return will be over the next 10 years. Maybe the market just goes up every year. And if you're counting on that, you're a little crazy. But it could happen, just like it could go down multiple times over the next 10 years.
Yeah.
I want a strategy that works regardless of what the market does to me over the next 10, 15 years. So if I'm going to be doing that situational issue that you were just talking about, I'm going to take that. I'm ignoring earnings at the moment on the cash portion of this, and I'm ignoring inflation. But if I need $120,000 a year for the next 4 years, and then $40,000 a year for the next 6 years, I mean, we're looking at $480 in cash for the first 4 years, and then I need 4 years from now, I need $240,000. Did I do that right? 6 times 40? No,
420.
420 for the 120.
We're not using calculators today, so
120 is 480. So I need 480 solid cash. Then I only needed how much after that? 10,000 a year.
Well, I'm saying 10,000. I'm trying to.
Okay, so 10,000 a year for the next 6 years, and so I'm going to put 60,000 in. So 480 plus 60 is 540. So I'm going to have 540,000 in cash, CDs, laddered bonds, things that if the market goes down, so what? I don't lose a dollar. I know my dollar's there. That means I've got the 500 or 460,000 left over. I can put in the stock market. And guess what? If it goes down next year, oh well, maybe I use some of my cash to buy in with the down market.
Yeah, and the reason you don't care,
but
Professor Plum,
I have protected myself from that downturn because I've given myself in this situation 10 years. The market go down and then recover. And most of the time now, 10 years may not be long enough for the worst case scenarios. We have had 10-year periods of time where volatile stock market investments, at the markets as a whole, have not recovered all the way. Most recently 2000 to 2009. Mm-hmm. But it gives me a much higher probability that I will get back to those more historic averages of 8, 9%, 10%. And over a 10-year period of time, if I'm earning 8% over that 10-year period of time, that $460,000 turns back into $1 million. And so I'm back to where I started with. And how much risk did I take with my cash flow? And again, I assumed no earnings on any of my cash flow. Realistically, we could put less in cash because we can earn some money on that cash right now. I've taken no risk. And so that's the strategy. The strategy is don't let volatility hurt you. But it also means use it to your advantage by having a long enough time horizon to let the unknown happen, both positive and negative.
Yeah, isn't it amazing how it all kind of goes back to this? What you're talking about is the bucket strategy. How it comes back to that, and the reason we do that, Professor Plum, is not to just keep saying this is where this is how we've been doing it for years, and this is the way we're doing it. Although that is true. We try to point out exactly why we want to do it this way, because you don't know what's going to happen over the next 5 years in the markets. We could have a horrible time. We don't know. And it's too risky to throw money into the stock market when you don't know what's going to happen over the next 2 or 3 years. I need that money in the next 2, 3, 4, 5 years.
That's the key. It's too risky to throw the money that I need to spend in the not too distant future into something that's volatile and I cannot control the outcome when I need to have the money. I have a controlled issue that I have to spend it in 3 years, but I have no control over the investment return of a volatile market. That's a recipe for disaster. But we know that the longer the time horizon, the more close to the historical averages we're going to get. At least it's always worked out to be that way. But the 1 year hold, 2 year hold, 3 year hold, that's some volatility right there.
Well, it is. And even when you get up into 6, 7, 8, 9 years, I mean, if it's money I'm going to need 8 years from now, I'm still not sure I want to put any of that at complete risk right now. And I don't think that's a good idea at any time. So
over the last 30 years, the worst 3 year rolling period of time, minus 16%. 3 years.
Wow.
So are you willing to take that risk? I'm not saying it's going to happen, but it has happened on a rolling 3 year period of time.
Sure.
In the last 30 years.
Of course. Oh, and that's only the last 30 years. I mean, I think if we go back 120 years or so, we're probably going to see even worse periods of time. Just think back to the late 1920s.
Well, let's go back to the last 154 years.
I knew you had a longer one there. I wasn't going to ask. I didn't know if you had it in front of you. What do you have?
the worst rolling 3-year period of time in the last 154 years is a minus 43.81%.
Now, we're going to discount those numbers somewhat because we're talking about the 1880s and 1890s.
And then, 1929, the Great Crash.
Yeah. We have some safeguards in place but there's no guarantee, though. There's absolutely no guarantee that something like that wouldn't happen. I think it's unlikely, but even so, if you only have 2 or 3 years at the start of your retirement where things, don't work out as planned, you have a down, 8, 9, 10% year, and then a couple years later, maybe you have another one that goes down 8, 9, 10%. I don't know. That's not that much, but it really makes a difference to your portfolio going forward.
When you're drawing money out of it, it is just a death knell. I mean, you're taking money out, and that money can never recover because it's not there to recover. You spend it.
So so when we say how much can you take out of your portfolio, just to sum this up, Professor Plum, the answer is the two-word answer that we have, of course, in nearly every situation.
It depends.
It depends, but it really does depend. However, you can use this 4% as a guideline and then adjust it based upon your
specific
individual circumstances,
needs.
Right?
And so the 4% guideline can be used as a very high-level planning strategy overall, not a specific investment strategy. Mm-hmm. But it gives you especially for younger than 65-year-olds, maybe you're 55, and you're looking at 10 years from now, and you think, well, if I'm going to need how much my portfolio, if I keep doing what I'm doing, I'm putting whatever I'm putting in my 401k, my Roth IRAs, and all that kind of stuff, my portfolio should be X amount of dollars given 7 or 8 or 9% growth over the, pick your parameters. Don't go crazy on the assumptions. I always try to plan a little bit low on the expected rate of return so that if I end up with too much money, that's an easy one to handle. But say, okay, so when I get to retirement, I'll have $2 million. That equates to maybe $80,000 of spendable cash flow at 65. Is that plus what maybe my Social Security will be enough to live on, or plus whatever pensions I meet? But it's a great way to look at planning like that. It is not a strategy to use to actually create the cash flow that you're going to need.
No, and I should also throw in that part of some of this high-level planning also includes things like healthcare, because even if you think that's all you're going to need at a certain age, I'm going to need to spend this at age 68, 69, 70. Here's what I'm. You don't know what healthcare needs you might have at that point. So I'm going to assume also that you've perhaps taking care of that with some kind of long-term care insurance or something.
Well, it's one of those things that before you get to retirement, before you get to the date that you want to, it's not something you just get to and say, okay, I'm retired. Now what do I do? You should be planning for it a little bit. And one of the things you kind of look at and plan for is, what am I going to do with long-term care? How am I going to deal with additional, and some of that deals with the personal issues of you. Do you have family members that have gone through long-term care? Or does everybody in your household just drop dead, and therefore long-term care is not an issue? I know people that they either live a long time healthy or they have heart attacks and die. Their family is just that way. So they're not as worried about long-term care as other people who have histories of other things that are very debilitating.
Sure. So it's all part of the planning process. If you want to know more about this kind of thing, you can talk to Professor Rick Plum or any of the Lucia Capital Group advisors, who have now are long time sponsors of this particular podcast and then radio show before that, TV show and all that. Lucia Capital Group, 800-644-1150, 800-644-1150. Give them a call. They do this stuff every single day. For whatever reason, Professor Plum enjoys this. I keep making fun of you for that, but it's something that, and I shouldn't say for whatever reason, it's actually very fascinating, to put the pieces of the puzzle together, to take all the knowns and then think about the unknowns and then put them together into some sort of plan is really a work of art, in my opinion.
Well, and I've been doing this since college. I mean, I went to college and ended up going to college for this particular career, and you don't do something. And I'm not 30 years old anymore, darn it. You don't do something for this long without enjoying it and having fun with it and being able to learn something along the way. It's kind of fun.
You're not 30 years old. Your career is older than they're 30 years old. So I hate to
That
put,
is true.
I hate to put that in your head, but 800.
My career with this particular company
I understand.
is longer than 30 years.
That's right.
This wasn't my first job in the industry.
That's true. We're both in that same boat. All right, 800-644-1150. And don't forget, hey, you can download. We have a couple of guides. We've got the Social Security guide. We've got the, we've got the estate planning guide. We have a retirement guide and a few things. All you got to do is go to luciacap.com, LUCIACAP.com, and you type it in the search bar there, and you can download it for free.
Hey, did you lose your cheat sheet?
Oh, because I didn't say Professor. No, I didn't lose it. But you know what? It's on the other side of the room here. Because I should have said Professor Rick Plum, certified financial planner professional, and accredited wealth management advisor. Right?
I just wanted to make sure that you.
No, and I'm losing the light in this room here. We're doing all right. This is again is our remote.
Another
broadcast.
remote.
Yeah, we're doing these from different parts of the country for a little while. But no, I didn't lose it, but I don't have it in front of me. Doggone it! I should have done that. You are a certified financial planner professional and an accredited wealth management advisor.
Yes, sir.
I've done pretty
well. Like I said, I've been doing this a long time.
You really have been doing this a long time, and I've finally got that down. Talked to them. They got a bunch of certified financial planner professionals there at Lucia Capital Group, and it's nice to have that designation. You can, podcast. Download this podcast. Spotify and Apple Podcasts. We can do both. And subscribe. Make sure you do. You get notified whenever there's a new episode, which is still every single week, like clockwork. Don't miss a single episode because I really believe you're going to be learning something every single time that you listen to this particular program. So Apple Podcasts and Spotify. Professor, I appreciate this. I really do. Taking time out of your day. I know you got another meeting to get to here shortly, so we're going to let you go. Anything else you had to add?
No, it's just everything, like you mentioned before, the answer to everything we deal with in financial planning is it depends. It depends on you, your specific situation, your risk tolerance, how you've set yourself up so far, where you want to be. You are not the same as anybody else out there. Cookie cutter rules do not apply. You have to do this based on your needs and situation.
Right. See, we've been working together so long. That's exactly the answer I was looking for. I threw it to you, and you knew exactly what to say.
Okay.
Wow, that's professionalism. Thank you so much, Professor Rick Plum. For Professor Rick Plum, I'm your podcast host, Johnny Dean. Thanks so much for listening. This is Managing Your Financial Future. We will talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. It is important to keep in mind that investments in fixed income products are subject to liquidity, interest rate, financial, inflation risks, and special tax liabilities. Interest may be subject to the alternative minimum tax. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Long-term care coverage policies and provisions may not be available in all states. Approval may be subject to the terms and conditions of the insurance company. Insurance product guarantees are subject to the claims-paying ability of the issuing insurance company and are subject to their terms and conditions. Insurance services offered through LPL Financial or its licensed affiliates. California Insurance License Number 0518721. LPLIA CA Insurance License 0B91442. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC.